Hello, it's Scott Letourneau with NCP and Sales Tax System. I want to share with you a couple key end of the year tax strategies and entity formation strategies that will come into play if you're looking to form a new entity for a new business, part of your business, business with a new partner, safe assets to protect. These are going to be critical strategies for you. So let me go ahead and share my screen and get a paper and pen ready to take a couple notes of how you can apply this to a new entity moving forward, or a couple of them apply to the entity you may have already formed this year to make sure you maximize expenses. So let me go ahead and share my screen. All right, let's talk about new entity strategies going into 2023 and tax strategies for 2022. So if you formed a business this year already, or I should say you formed an entity already, or if you're looking to form an entity the last few weeks of the year, one of the key questions when it comes to writing off all those expenses, getting your business ready, is are you still in startup mode? And for many of you, if you want the deduction in 2022 for an entity you formed or going to form to the end of the year, you want to get into business mode and start a sale. So what this means is a lot of you may be in what's called startup mode versus what is operational mode, and there is a difference. Startup mode equals a situation where you are organizing all your expenses, the marketing and the cost to get things ready to launch. If you're an e-commerce seller, maybe you're developing a product, you've done everything. You've set up, you're getting brand registered, the Amazon account, all these things set up, and you maybe spent thousands of dollars, but if you're in startup mode, you cannot take those expenses as a write-off in the same year unless you switch to what's called operational mode, aka in business. And what that means is you had your first sale, you developed revenue. So when you have your first sale, you can then take all those write-offs and expenses in the same year. We work with several CPAs and tax attorneys on these subjects, and this is an important distinction that some people forget, is you want to have your first sale. Now, the goal is likely to switch from startup mode to operational mode, and I say likely to switch, meaning to have your first sale in 2022 at the end, by the end of the year. Assuming you want this write-off this year. But some of you may be in a situation that maybe you don't need the write-off in 2022. You'd have the write-off in 2023 when your profits are going to be much greater. So if you don't switch to operational mode in 2022, the good news is you don't lose the write-offs. They just move forward into 2023. So if you're counting on a big write-off in 2022 and you're still in startup mode and you haven't made a sale, that's probably not going to happen. So you might owe more taxes next year. And the good news is you might pay more taxes next year, but the write-off will flow through into next year. If all that's going to be an issue based upon your overall planning, then you want to see if you can get in a position to make a sale, to have revenue coming in, to have the write-offs for this year. So that's important. Whether you formed an entity this year or going to be forming a new one towards the end of the year, and you want the entity to be in business, in operation mode in 2022. Most of you are going to do the next step is you're going to be forming an entity to get ready for 2023. And we're going to incorporate or form an LLC now in 2022 to make sure you're in position for the beginning of the year. We want to do what's called a complete formation, one that has the operating agreement, the minutes, the resolutions that match up to the entity formation. Remember, when you form an entity, it has liability protection on day one. After day one is based upon, do you operate as a separate legal entity? You want to make sure the entity veil is pierced. Ideally, you have adequate business liability insurance, which a lot of people don't get. So you could be exposed that way, and it's very important to have a complete formation. When we form the entity now, we will look at having a start date on the SS4 application of 2023. This will avoid a short year return. If you have an entity that's taxed as an S Corp, it'll do 1120S. A partnership would be 1065. Or a corporation with a December 31st year end would be 1120. Now, in the corporation, it's a fiscal year end. So if we formed an LLC taxed as a C Corp, we could obtain the EIN number and you could choose a fiscal year end. And you also have some other unique strategies the first year when you form a C Corp in choosing a shorter fiscal year end, which can help in tax planning. The exception here, of course, if you have a single member LLC disregarded owned by an individual, whether you form the entity now, and let's say you're already going to be filing Schedule C, and you're going to have some expenses and maybe some income by the end of the year. If we do it now, it's still going to flow through to Schedule C. Now, if you didn't have any Schedule C and you were a W-2 employee and you didn't want to file an additional Schedule C, you'll want the start date to be 2023 also, unless there's some compelling end of the year reasons. Earned income will flow through to Schedule C or I should say the income on Schedule C will be taxed as earned income. It'll be subject to the 15.3% self-employment tax. When we form an LLC or corporation, a lot of people, the name's pretty simple, but there are some issues that come up. Was the name used before, particularly in the state? Was it revoked? Was it around for a long time? Is that a name that you might be hit with a lawsuit? We've seen that happen over the last 25 years, that somebody forms a new company and it has the name and it gets hit with a lawsuit and it was really intended for the previous company that was revoked. So doesn't mean we never do that, but that's something to be aware of. Is the name available in 2 states? Are you going to form a company in Nevada to protect the entity veil and foreign register in another state to give yourself a greater level of liability protection? If you're going to be doing millions of dollars, you have some liability and risk in your business. It's a very inexpensive insurance policy. It makes it more complicated to get through the entity. But we should check the name in both states. That's why we do the foreign registration. Some people have us do the entity and they'll say, we'll foreign register on our own. Then they forget that step. So it's really important if we're going to be looking at 2 states. Maybe you have some ownership in another state. Should you trademark the name? Maybe you're trademarking a brand name. The brand name might be a DBA name. We should file underneath the LLC or corporation. Keep that in mind. Now, we do incorporate in all 50 states. I should say that. I know I gave the Nevada example for a higher level of liability protection, but if you want to incorporate in your home state, we can do that for you also. A couple other items to keep in mind when we form a new company: should be managed by managers or by members. The decision impacts privacy of ownership, flexibility in making changes, meaning if you do it one way, you got to amend the articles of the state and the operating agreement. If you do another way, you're updating the operating agreements. It's much better. Are you bringing on new managers in the future and you don't want them to have ownership? All these things are affected by this, and most, I would say 90% of the online kind of just filed online simple processes by default have this incorrect. That puts you in not the best position. The operating agreement, this is a really advanced strategy. I'll comment on it. Might be a little bit over some of your heads. No, it's just from an advanced legal research we did on this. Most operating agreements will distribute profits to all the owners, even when there's a charging order against the company. So we researched this in cases about the charging order, not to negate the effect. So our operating agreement doesn't have language that puts you in a negative position. So the charging order is a positive level of protection if somebody comes after you. When you set it up properly, you can also add like call it a poison pill to the strategy that would make it more difficult if somebody wanted to come after your ownership if they don't automatically get a distribution of profits. So that's a really important liability strategy that most people don't cover in their operating agreements. The charging order, can that be negated if you only have one member? So there's a couple of states that if you're counting on the charging order protection as added layer protection, if you need it, some of you might be consultants that may not make any difference if somebody went after the ownership of your business, because the day you stop consulting, the day you stop bringing in revenues, that's a different approach. So, but if it is valuable, there's some value in the company, whether you're involved or not involved, then this, if you're in a state that limits the charging order, like Colorado or Florida, then we may have to look at plan B of how we might add that in without causing tremendous complexity to your situation. These are things I would cover in advance. We call a strategy call and go through some different options for you. Are you going to be opening a new bank account for the company? Of course, most are going to say yes. You have to keep in mind simple things on funding. Are you depositing income in the account? Is it going to be a check? Because you probably don't have, your online merchant account set up yet. Is money wired in the account? Are you opening a bank account in another state? And we're going to do a Nevada foreign register. But in order to open the bank account, you have to be foreign registered, and you don't want to trigger that by the end of the year. So there's different things that go into play. We do have access to an online bank account. That's a full functioning account that we can avoid the foreign registration process, but we do need the EIN letter from the IRS, which takes a few weeks after formation. So there's a couple of things that come into play there when it comes to banking. So as we said, we look at the different things from a different state. We have to foreign register. If you want to work with a non-traditional bank, like I mentioned, we can have that. It's not, when I say non-traditional, it's online linked to a traditional bank, but not like just Bank of America, Wells Fargo, things of that nature. Ownership structure and capitalization. This is critical upon the formation. Before and after, to think through this. Is the ownership going to be an individual entity? And are they in the same state, another state, or another country? So if you have a partner who's in another state, what does that do to the situation? What if the partner's in another country? How does that impact taxation? Even could be in another state, could impact taxation. You have one partner in California and one partner in Florida, and they're the owners. That's going to be a different impact based upon how we structure it if we don't need to foreign register in both states. So these are a couple of key things to keep in mind. And finally, you want to set up your entity in a position that you can build a strong business credit profile, which means what are the elements have to be done with the structure of the company and congruency and everything. So when you go to Dun & Bradstreet Corporate Experian to set up a business credit profile, to get vendors reporting, to build up your financial credibility, which is going to add more not only to vendor credit, but also to some credibility when it gets to partnerships, joint ventures. Walmart checks your Dun & Bradstreet number. They want to know you look like a real U.S. type company, and these things are important. And this all leads to then cash lines of funding to maximize that. So that's an important component that we focus on also. So these are some tips and strategies for you. If you already have an entity going into the end of the year looking to form a new entity, we do have a Black Friday special. It'll be below the video, the details, and also in the email. So if we can help you form another entity, go ahead and make the payment, secure the discount. You don't need to submit our web form right away to us. We have additional training on that. You have some flexibility in time. And once you go through that training on the web form or the video we have there, if you really feel like you need a strategy call with myself, which is a separate fee, we can also do that for you. So these are some of the areas of how we can help you move forward and launch with confidence going into 2023. If you have someone else that is looking to start a new business, form a company, they want to get in our ecosystem, you can go ahead and refer them to us. We'll take great care of them, and we'll take them through this similar process to get access to our resources and also tremendous amount of bonuses that are advanced training that we do in the back end also that are a part of what we do here at NCP. So again, my name is Scott Letourneau. Look forward to working with you again with the new entity formation, and have an outstanding day.